All right, let's just dive right into this explainer. We're going to take those wildly chaotic crypto charts and transform them into clear, actionable signals. If you've ever opened up a trading platform and just felt completely overwhelmed by what you're looking at, believe me, you are absolutely not alone. Today, we're breaking down one of the most powerful yet wonderfully simple tools in the entire trading world.
It's the million-dollar question, isn't it? Staring at those fast-moving red and green candles? Man, it can cause absolute emotional panic. One minute, the price is rocketing to the moon. The next, it's completely dumping. It feels like a totally random roller coaster. But the pros? They use a very specific tool to cut right through that noise because they know the market isn't random. It's just incredibly noisy.
So here's our roadmap for today. We'll kick things off by finding clarity in the chaos, define exactly what moving averages are, compare the SMA to the EMA, show you how to spot trends and crosses, build a practical trading strategy, and wrap it all up with the ultimate trading truth. Let's get into it.
Starting off with Section 1, Finding Clarity in Chaos and the Core Problem with Price. Look, the truth that experienced traders figure out pretty quickly is that raw market data is totally emotionally misleading. To wrap your head around this, just imagine checking a city's temperature every single minute. At noon, it's 30 degrees. A minute later, it's 31. Then it dips to 29, then spikes back up to 32. If you're obsessing over this tick-by-tick data, the climate seems completely erratic. You'd be packing a winter coat and a swimsuit just to walk down the street. And honestly, that is exactly what staring at raw, tick-by-tick crypto price action feels like.
But here's the fix. If you take all those erratic minute-by-minute temperatures and just average them out over an hour, the picture changes entirely. Suddenly you realize, oh, the city is just warm and stable, hanging around 30 to 31 degrees. You've literally turned chaos into clarity. And that is the exact principle we apply to financial charts, so we can stop making these panicked, emotional decisions based on tiny, meaningless price blips.
Which brings us right to Section 2. What are moving averages? Basically, your direction compass.
So, a moving average, or MA for short, is just a smooth line plotted directly on your chart. It continuously updates to show you the average price of an asset over a specific period of time. Instead of hyperfixating on every tiny anxiety-inducing jump, this simple math essentially flattens the market into one highly visible direction line. And it moves because every time a new trading day or hour closes, the oldest piece of data drops off the back and the newest one gets added.
But what's really fascinating here is the psychology behind the math. Moving averages actually show you the average behavior of traders over time. Since financial markets are driven by pure human emotion, fear, greed, patience, panic, this average acts as a massive psychological compass. It essentially tells you who's winning the tug-of-war on average, the buyers or the sellers. It shifts your brain entirely away from the noise and grounds you right in the structural reality.
Moving on to Section 3, SMA versus EMA explained, and choosing your tool.
When you fire up your charting platform, you're immediately going to see two main types of moving averages. First up is the simple moving average, or SMA. Think of the SMA like a balanced class average score in school. Every single day in your selected time frame carries the exact same weight. On the flip side, we have the exponential moving average, the EMA. Think of this one more like a recent performance review at work. What you did yesterday matters a whole lot more than what you did 10 days ago. The EMA is mathematically weighted to be way more sensitive to what the price is doing right this very second.
So breaking it down, the SMA is slower. It has lower sensitivity, which makes it absolutely fantastic for identifying long-term stable trends. The EMA, however, is fast and highly sensitive, making it your go-to for short-term trading, where you really need those quick reactions. If you're a beginner, honestly, you might want to kick things off with the slower, more stable SMA. Why? Because it smooths out the chart beautifully and drastically cuts down on panic decisions. Active daily traders, though, they usually favor the faster EMA to catch those rapid momentum shifts. And hey, a lot of pros actually layer both on their charts to get the absolute best of both worlds.
All right, Section 4, Spotting Trends and Crosses. Let's translate these lines into real analysis. So how do we actually read this stuff? It really boils down to a few essential rules. Think of the moving average line as your middle point of balance. Rule 1. If the price stays above that line, we're broadly in an uptrend. The buyers have the upper hand. Rule 2. If the price is below the line, you're in a downtrend, meaning sellers are in control. But don't just look at where the price is sitting. Pay attention to the slope of the line itself. If the slope is pointing strongly up, bullish momentum is building. Pointing down, bearish momentum is running the show. It literally is that simple.
The real magic happens when we look at major shifts, which brings us to the famous golden cross. A golden cross is a massive bullish signal. It happens when a fast, short-term moving average, like your 50-day MA, crosses straight up and above a slow, long-term moving average, like the 200-day.
The market impact here is profound. It's basically telling us that recent momentum has drastically shifted away from the sellers and over to the buyers. The downtrend is pumping the brakes, and we are looking at a potential new, long-term bullish phase. I always like to think of it like an exhausted sports team that suddenly finds a second wind and just completely overpowers a historically stronger opponent. It's a huge confirmation that the long-term bias has officially flipped.
But of course, we also have the exact opposite scenario, ominously known as the death cross. This is a big bearish signal, and it triggers when your short-term moving average crosses sharply below your long-term moving average.
When a death cross prints, you're seeing a heavy momentum shift from buyers back to sellers. The uptrend is clearly weakened, and it's signaling a potential long-term bearish phase is kicking off. Now, please listen closely to this super important caveat. Both of these crosses are lagging confirmation tools. They are absolutely not instant triggers to blindly smash the buy or sell button right that second. They just confirm a macro trend change that is already happening, helping you align your broader, big-picture strategy.
Which perfectly segues into Section 5, Building Your Trading Strategy, the Practical Playbook.
Let's actually build a practical, rule-based approach right now using just a 50 SMA and a faster 20 EMA. Step 1. Check that slow 50 SMA to find your overall big-picture trend direction. Are we riding above it or below it? Step 2. Check your fast 20 EMA. Is it pointing the same way as the 50? That confirms your momentum. Step 3, and listen, this is where almost everyone messes up. Wait patiently for the price to pull back to those moving averages. Do not chase a flying green candle. And finally, step 4, look for a strong price reaction at those lines. We want to see a clear bounce acting as support, and only then do you enter. This sequence keeps you perfectly aligned with the actual market structure.
But look, we absolutely have to talk about risk management, because even the most perfect technical setup in the world can and will fail sometimes. That's just the reality of trading. You always have to use a stop loss and only risk a tiny percentage of your account on any single trade. Protecting your capital is honestly vastly more important than any moving average indicator. Trading is purely a survival game. You just need to stay in the game long enough to let the math and the probabilities work in your favor over time.
And that brings us to our final section. Section 6, the ultimate trading truth, discipline over prediction.
To wrap up this explainer, we really need to address the hard psychological reality of using these tools. Here are the biggest mistakes you've got to avoid. Number 1, treating moving averages like they're magical crystal balls. They don't predict the future, they only react to the past. Number 2, jumping into a trade the millisecond the price touches the line. Always wait for confirmation. Number 3, trying to be a hero and trading directly against the trend. If we're below the moving average, don't blindly buy the dip. And number 4, ignoring the higher time frame. Your 5-minute chart might look super bullish, but if the daily chart is falling off a cliff, you are in trouble. Moving averages don't predict, they enforce discipline so you avoid these emotional traps.
If you take nothing else away from this, remember this quote forever. No indicator will make you profitable on its own. Not the SMA, not the EMA, not a fancy golden cross. What actually makes you a consistently profitable trader is deeply understanding market structure, ruthlessly controlling your risk, and having the emotional discipline to flow with the market instead of stubbornly fighting it. These tools are just there to quiet the noise so your human brain can clearly execute your plan. So, I'm going to leave you with this final thought. Are you ready to stop trying to guess the future and start actually reacting to what the market is showing you? The chart is speaking to you every single day. It's entirely up to you to listen. Turn that chaotic noise into actionable structure. Thanks for hanging out with me on this explainer, and happy charting!